Thank you very much for including our paper in the program, and special thanks for organizing such a thoughtful and well-planned event. My name is Mustafa. I'm from University of Alabama. I will present a research paper today, a joint work with Christopher James and Tao Li. Both of them are from Gator Nation. In the earlier session in the morning, we discussed that two of the top three concerns among community bankers was funding cost and net interest margin. So our paper is really related with the funding cost of the banks and the bank's exposure to interest rate risk. So the motivation for our paper is recently policymakers has been implementing a tightening monetary policy, and in popular media you see some of the news that maybe banks are maybe some of the banks are exposed to interest rate risk, and that may be a concern. When we think about banks' exposure to interest rate risk, the conventional wisdom that we thought about is banks engage in maturity transformation, meaning that they take short-term liabilities and they finance long-term assets. And this business structure will expose banks to the interest rate risk, because if short-term interest rates increase, banks' interest expense will increase relative to interest income. That will suppress banks' profitability. Consistent with this view, most of the studies in this literature finds a negative relationship between interest rate changes and banks' equity returns. One common way to quantify this effect is researchers usually look at the short-term rate changes, and on the following day the index return on bank stocks. And if we want to quantify this effect, this chart will show you the index return, bank index return following FOMC meeting dates. And to generate this chart, we use a 2-year rate, 2-year treasury rate. And what this chart will say, if treasury rates, 2-year treasury rates increase by 1%, you would expect 4% decline in bank equity return. 1% increase in 2-year treasury rate over a day is very rare, so take this with a grain of salt. But what this will suggest is bank equity's duration is positive. When interest rates are increasing, bank equity tend to lose value. This is what literature says. And what we did is we look at banks' maturity gap between assets and liabilities. Here, what you see in blue line is a median publicly listed US banks asset maturity, which was before financial crisis around 4 years. After financial crisis, it jumped, and it is around 6.6 to 6.5 years. On the red line, you see the maturity of bank liabilities, which declined slightly. As you can see, before the financial crisis, the gap between asset and liability maturities are kind of smaller. After financial crisis, it increased. And if we ask very same question, whether bank equity investors more severely affected from this extension of maturity gap after financial crisis, what we find is very interesting. We find that after global financial crisis, even though maturity gap increases, any increment in benchmark rates would be positively associated with bank stock returns. So bank investors really like interest rate increments in the period after financial crisis, which is a little bit puzzling. It was a puzzling result. We observed this negative duration of bank equity following financial crisis, and our research question was basically what would explain shortening of duration of bank equity following global financial crisis. And we built an explanation for this question, and our explanation relies on recent insights in this literature. Recent literature suggests that banks operate deposit franchise, and banks usually have a market power when they are setting their deposit rates, and that can be insensitive to the interest rate changes. Because of their market power, they can set deposit rates that are insensitive to benchmark rates, and that will be, deposit franchise will be a natural hedge to interest rate risk exposure. Building upon this idea, what we did in this paper is we tried to understand the value of deposit franchise in two different time periods, before financial crisis or after financial crisis. Formally, we define time periods as low interest rate environment or high interest rate environment based on effective Fed funds rate. If effective Fed funds rate is lower than 2%, that will be a low interest rate environment in our sample. And the important thing that we are looking at in this paper is banks usually pass through a portion of changes in effective Fed funds rate. If federal funds rate increase by 25%, banks do not increase the deposit rates by 25%. They have some decision to make, and they can set the deposit rates. Our main focus here is how much of the changes in benchmark rates are being paid out to the depositors. To answer those questions, what we collect public data from call reports. We thank Federal Reserve Bank of St. Louis for providing enormous data sources for this project. So we have one thing that I need to explain is the pass-through rate. How we calculate the deposit pass-through rate, which we're going to call deposit beta. So deposit beta is basically a change-on-change ratio. Our numerator would be the change in bank's deposit rate between 2 quarters, and our denominator would be the change in effective Fed funds rate for the same time period. This change over change ratio will give us an idea about how much of the changes in effective Fed funds rate being paid to the depositors. There are some issues with this measure, because if a bank is slowly adjusting deposit rates, this measure will not be completely reflecting these changes. Alternatively, we also implemented more sophisticated method where we run a simple regression where we had an explanatory variable, which is change in effective Fed funds rate up to 3 lakhs, and we calculated the change on the deposit yield as a dependent variable, and we sum those coefficient betas for each effective Fed funds rate. That will give us another measure of the deposit beta. So with that, let me give you some statistics, some summary statistics from our sample. What we first observe is the following. In high interest rate environment, the average deposit beta banks give to their depositors is around 2.8%, which is 1.2% in low interest rate environment. Again, high and low interest rate environment are based on whether effective Fed funds rate are above or below 2%. One interesting fact that we observe is the deposit gap. In high interest rate environment, the deposit gap on average is 1.7%, meaning banks can take a deposit from depositors, put that money to effective federal funds market, and take some profit from this operation. In low interest rate environment, the deposit gap is negative, meaning that banks would have negative income from operating deposit franchise. In low interest rate environments, interestingly, we find that banks' non-interest income is much higher. So they tend to compensate these differences with non-interest income. With respect to our measure, we calculated these deposit betas, and deposit betas in high interest rate environment is around 49%. So around 50% of changes on effective Fed funds rate will be paid out to the depositors in high interest rate environment. In low interest rate environment, this rate will be 25 to 30%. And we also look at the decomposition of deposits because over time, after global financial crisis, we see a trend that the weight of time deposit increase while the weight of savings deposit decline over the time. But regardless, whether we calculate the deposit beta for time deposits, savings deposits, or a traditional transactional deposit, we find that in low interest rate environment, deposit betas are lower. Next, this is our first result. What we did here is we establish a relationship between the levels of interest rate and deposit beta. And what we find is if interest rates are increasing, deposit betas will be positively associated with that. We also include a square term over there to look for nonlinearity. And this relationship is not linear. Actually, this relationship is concave, and this relationship will be peaked around 3.4 or 3.5%. What does that mean? We're going to see some reversal in the equity returns around 3.3 to 3.4%. So if you are bank equity investors, you would be happy to see interest rates are increasing up to 3.3 to 3.5%. But after that point, any increment in interest rates would be detrimental for equity investors. Those are the associations that we found in the data. We also look at whether banks that rely on uninsured deposits are more prompt to reflect the changes on the effective Fed funds rate to the deposit rates, and we find then evidence that if banks rely on uninsured deposits heavily, they tend to have higher deposit betas. They try to keep their uninsured depositors, so they're gonna reflect changes on effective Fed funds rate in their deposit rates. The third thing that we show in this paper is whether these deposit betas or changes on deposit rates are discussed in the earning calls. So for this, we downloaded transcripts of earning calls, and those bars are showing the proportion of earning calls where equity analysts or the bank itself will talk about the deposit betas. And what we find is the red line is the effective Fed funds rate. We kind of find a very strong correlation between the discussion of deposit betas in earning calls and the rate environment. And those are all showing us that deposit betas has time variation. And the last thing we look at it, we have a number of different tests in the paper, but one thing we document in this paper is whether deposit betas are related with the bank's exposure to the duration of the bank equity. And for bank equity, we calculated two different measures. One is yield beta, which is basically calculated looking at stock returns for each bank in a given quarter. And the second one is FOMC beta, which is the bars that I showed earlier. And what we find is a negative strong relationship. Whichever specification you implement, we find a negative relationship between the deposit betas and duration of bank equity, which would suggest that maybe deposit franchise is not a perfect hedge for interest rate risk. If it is a perfect hedge, you will see no relationship in this table. So overall, our takeaways are we have two main takeaways from this research. One, we document that deposit betas have time varying feature, which would inherently affect the ability of the deposit franchise being a natural hedge to the interest rate risk. Thank you.